regular market analysts, Walt Hackney and Doug Jackson. Gentlemen, welcome back. Walt, Doug, good to see you. Doug, let's start with this wild grain market. Let's start first with the wheat, 61 cents. Pretty big gain in the wheat for the month of October.
Mark, the grains are starting to unfold much as we talked the last time we were together. We've seen a dramatic drawdown in world inventories. Our food security is now jeopardized with a multitude of things that are all coming together in somewhat of a perfect storm. Of course, the tight coarse grain situation is part of the picture, the biofuels surging out of control, but the real catalyst in the wheat is what is now going to turn out, it appears, to be the second major catastrophic drought in Australia in 4 years. Their crop may be no more than 10 million tons, down 14 million tons from a year ago. And that, combined with a short crop in the Black Sea and Western Europe and Brazil, is creating what now appears to be the tightest world wheat situation in modern times.
It's going to obviously have an impact on the wheat world. It's had an impact on corn and soybeans as well. What's a producer to do at this stage of the game?
Well, obviously at 10-year highs, Mark, it's risky to be bullish. It's imprudent to say not to make sales. Some private analysts are projecting up to 4 million more winter wheat acres next year, which if we have good weather, which is a big if, we could certainly rebuild inventories and be down sharply a year from now. But you have a school of people that are looking for $6 Kansas City wheat as the short-bought world buyer starts to wake up to the realities of limited inventories and availabilities worldwide that will eventually push demand back to the United States. We've seen out-of-control speculative short covering and forced margin liquidation in Chicago. The Chicago market may be overdone in the nearby contracts, the spreads too inverted, but we're still getting speculators out of that market where the open interest is 4 times the size of the crop. But some sales obviously could be made here, obviously, but to judge the upside potential here is difficult. We can still see highs later this winter. Typically these things don't roll over and come to an end, unfortunately, Mark, until next April, when you can start to see those new crop supplies. But we could still have substantial upside if we see any unexpected demand this winter, and it's worth hanging on to speculate on that too.
All right, several people have called saying, what about this corn market? We know there's going to be a big crop, USDA 10.9 billion bushel crop, 2% cut as we mentioned, but still adequate for this year, and yet a huge rally over the corn pit too.
Well, that's right, Mark. The catalyst here this week was partially the slightly smaller production estimate, a yield down about a bushel and a half from earlier expectations. But that was a surprise. That's a relatively rare event. Typically big crops get bigger, and that's dramatically changed the market's anticipation, because now we know that in practically every time when the October report is below September, the final report gets smaller. Well, now what we have then is a biofuel situation that's out of control. We hear many analysts relying blindly on the concept of productivity is going to bail us out of this problem. But if we narrowly define productivity as increasing yields, the idea that that's going to create enough increased production to offset this biofuel is absolutely ridiculous. The bottom line, Mark, is very simply, and the market's starting to understand the inescapability of this reality. You're going to need 10 million more corn acres in the next 2 years and record yields, or you'll simply run out of corn in the 08 balance table or even sooner. And what's happened now is this year's 07-08 crop, or the 06-07 crop rather, is getting so tight that the spreads are going to start to tighten up. And while the real story is 07-08, where if you don't get millions and millions of acres, you'll start to run out of corn next year, the old crop's tight enough it's going to follow in tandem with the 07. So here we have prices that arguably are going to be very volatile, could be somewhat overdone in the very short run. But Mark, the trend is higher. You have 3 scenarios ahead of you. The first, of course, to be fair, is that we have spectacularly good weather next year, a 1994 style yield above trend. And you could delay the situation I'm describing. But if you have normal weather, not bad weather, just normal weather, you have 2 choices. You're either going to take corn prices high enough where you devastate livestock feeding margins, which might be $4 or $5 corn, or the alternative is you take prices in a low crude oil price environment, such as we have now. And that's the one thing that's different from the last time we talked. You'll have to take prices to where you wipe out ethanol margins. And that might be something near $3.50. Mark, these investors that have been blindly throwing money at these biofuels and ethanol investments the last year or so for plants that won't be built for 2 or 3 years, may be looking at a dramatically different set of arithmetic than they ever imagined when they first made those investments.
All right, so you're not in a big hurry to make corn sales.
Long-term trend is higher. The target basically is either to get to a level on the new crop where we have 5 million more acres next year, which would be unprecedented, or to take futures to a level where ethanol margins turn negative.
Let's talk about soybeans, Doug, and of course there's a biofuel component there as well. USDA numbers were bigger for the 06 soybean crop, but those August rains did pay off. What's your take on soybean prices going forward?
A record crop projected, the second highest yield ever. We think the yield is even bigger, a clearly record yield. The government estimated carrying out over 550 million, the largest ever, about the second or third biggest carry-out to use ratio ever. We think the crop's bigger, carry-out could be 600 million. Soy is not the leader, it's not going to be the leader. We think we can make multi-year lows next spring and then move higher to buy in acres very long term to compensate for the acreage that's switching from soy to corn in the United States. But it's not going to be the leader. We could see some downside potential, but beans are obviously following the other two crops, the wheat and the corn, trying to stabilize acreage distribution. Not a lot of upside potential, but again, just a follower to the feed grain.
All right, fascinating scenario going forward. Walt Ag, it's been a fascinating but unprofitable week in the